to a brand new episode of Investor's Guide, India's longest running personal finance show. We've changed the look of the show and also a little bit of the information that you're going to get through the week. But one thing that doesn't change and has not changed over the last 7 years is that we're here to help. So anything that you want to ask us about your money. Now, our special focus is, of course, mutual funds, because we believe that's the best way to approach this market. But if you want to just talk about your savings, your home, your EMIs, or even the loans that you're managing, write to us. Our email ID is at the bottom of your screen. You can reach me personally as well on Twitter. Over the next half hour, we'll first of all take a look at our aggressive portfolio. Now, it's been a choppy market. We'll find out through this portfolio what your reaction to the market should ideally be. In our product review, it's the Quantum Long-Term Equity Fund. And should you invest lump sums or SIPs? That's what we're going to find out later on the show. All right, let me bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us on the show every week. Dhirendra, thank you so much for joining us. We're going to take a look at our aggressive portfolio. And the reason why we're looking at it right now is because I want to use it as a model for everybody who's investing in mutual funds to help them understand how to approach this market's volatility. Now, we saw the Brexit vote happen, and in the 2 weeks that followed, there's been a fair amount of volatility in the market. And even though our markets recovered from that day's, pain that we saw, a lot of analysts have been telling us to expect volatility in the months to come. Now, while we look at the returns on this portfolio, I want to understand from you what your advice is for any mutual fund equity investor in this market.
The advice is the same. You manage volatility at two levels. One is that you stagger your investments over time, but when you see, after your investments have accumulated substantially, your portfolio will be hurt by volatility, or will experience volatility. Investors should worry if they accidentally happen to be in a situation that they are faced with an extreme volatility, and their goal is approaching fast. They somehow have not realigned their portfolio to their goals, which could be in immediate future. You have been investing for 10 years. And you need the money in 2 years' time, and that time is now, and you witness a 10% decline or 5% decline in few days, and you get worried. As you invest methodically, as you get closer to your goals, reduce your allocation to, you should be in more stable asset classes, which is insulated from that risk.
All right, so if you're young and you're aggressive, you should be able to absorb the kind of volatility that we're seeing in the market because of the time you have on your hands as an investor. Let's take a look at this aggressive portfolio. Now, remember, this portfolio was designed 7 years ago, and this is where it is in terms of its allocation and its returns right now. We have the DSP BlackRock Short-Term, Franklin India Smaller Companies, iPru Value Discovery, IDFC Premier Equity, Quantum Long-Term Equity. Now, the idea behind this particular investment is it's designed for a 25-year-old, someone who has a lot of time on their hands and also can absorb a lot of the volatility. Now, 10,000 rupees every month has been invested in this portfolio, and it's currently at a total value of 16.48 lakh rupees with a total gain of 18.55%. Do you want to make any changes in this portfolio? Do you think it works fine the way it is and you should just continue it in this manner?
No, in coming times, we will be making some changes. The changes will broadly be driven by the fact that this aggressive portfolio is no longer as aggressive. We can bring in the aggression with higher allocation to something which is likely to perform, or taking a tactical bet more often. But we are going to continue this 10% allocation to fixed income. And two things which has come to my mind, that this portfolio even now tends to be nearly 40-45% into large caps. That will come down a bit, and we are going to add at least 10 to 15% international allocation, either through an Indian fund which invests abroad as well within the fund itself. That will be more tax efficient, or maybe add one more fund, one international fund which will add selectively add one more fund to add that international exposure of a kind which will be good reflection of its name, the aggressive portfolio.
Well, Dhirendra, that's the next question for all of the international fund investors right now. Having seen Brexit and seeing, obviously, the global markets took a very, very large beating. Anybody who had invested, especially in the European markets, would have had a very difficult week. So for those of our Indian investors who've invested in the international markets, should changes like this worry them?
These changes should not worry them if they have actually thought through it, that why they are there in the first place. if they are actually not investing in with a short-term view. And Brexit, kind of thing will keep happening. If you remember, new expressions get coined every now and then. That is the nature of the market. People will try and make a big news out of some event. We had the not so impactful Brexit. Now we have the Brexit. We have come across new expressions around market and panic caused around some special events, and this will happen. I think having the rationale, having the reason why you are invested at some place will cause will make a whole lot of difference. If you are there without a reason, if you are there thoughtlessly, if you are there just because something was going up, then you have a problem.
All right, so then you have a problem. So remember, you have to always have a reason for every fund that you've picked. And if you want, actually write that down on a piece of paper and pin it up to your board so you remember why that fund is in your portfolio. Let's move on now to our new segment. It's called Your Financial Plan. Our profile today is an NRI. He's in his mid-30s. He's supporting a wife and 2 children, and his goal is to retire in the next 26 years. So the reason why I'm putting this up is because if you fall into any of these categories, whether that's the age bracket or your goals, you know that a lot of the advice on this particular answer will also apply to you, so you can write down some of that advice. Rakesh Gupta has sent us his portfolio. Dhirendra, a citizen of Australia who lives in Melbourne, he tells us he plans to return to India in 6 years and set up his own business and retire about 26 years from now when he turns 60 years old. He has a 3-year-old daughter and a soon-to-be son who will be born in September. Congratulations, and I wish you very, very good luck, Rakesh. He also tells us he wants to build a corpus of 3 crore rupees for his children over 20 years, 6 crore rupees for his own retirement over 26 years. Well, before we get into his financial details, Dhirendra, I have a quick question for you that I know a lot of people will have on their minds. Now, so many of us have family members who live overseas, and I know a lot of NRIs watch this show as well. My question is simply this. There's obviously a difference in interest rates between what we make here in India and what's made overseas. And that can be evened out by using the NRE deposit, where NRIs overseas can invest in an NRE deposit and make the interest rate without paying tax. My question is, does it make sense for NRIs to wire money back to India and invest it in Indian equity mutual funds? Or does it make sense for them to just use investment plans or superannuation plans or insurance plans where they live? What is the benefit of using an Indian mutual fund for an NRI?
An Indian mutual fund could be useful, but in the long term, it will not make much of a difference, because what you earn by way of higher inflation, hence higher interest rate, hence higher equity return, will be taken back by currency depreciation in the long run. So the difference will not be as much. But there's another way of looking at it. India right now might justify a higher allocation. I think the prime factor which should drive anybody's allocation to different geography or different countries or different asset classes should be to optimize, or maybe for your long-term assets, maximize your return without assuming substantial risk. And from that standpoint, your risk actually, for a stranger, India could be very risky. For an NRI, the risk may not be that high, simply because you understand it and there is a home bias and you know where you are investing. And then comes, what one should do with those superannuation funds, or if one is at liberty to exercise that choice, then same principle will apply. But if you don't have a choice, then you have to stay put. So it's entirely a matter of how much flexible the retirement plans or retirement funds or the retirement investment, the long-term retirement benefit system of that country is.
All right, so keep a very close eye on the investments that you're making, but I think all NRIs should take advantage of the NRE deposit. It will give you an interest rate that is unmatched currently in most developed nations, and you don't have to pay tax on that amount. Dhirendra, let's take a look at his portfolio. He currently saves about 1.25 lakh rupees every month, and his total savings at this point is close to 58 lakh rupees in various, emergency funds, some money he's lent to a friend, some in his NRE deposit. He wants to use this money to sort of kickstart his investment for his child. And he has a fair amount of real estate as well. There's a home in Melbourne on which there's a running home loan. He also owns land in India, and he is going to inherit about 1.3 crore rupees of property from his parents. And he's using the superannuation fund that, like we talked about, that's available to him. as an Australian resident. He tells us, of course, Indian websites on calculators are saying he'll wind up with a corpus of 6 crore rupees, but that's not the same he's hearing from Australian websites. So if you look at his entire portfolio, there's a fair amount of savings there that he's put together. There's enough real estate to sort of give him a base when he comes back to India in terms of income generating or cash generating money. What would you like him to do to sort of meet that goal? Because those goals are high. In order to meet those goals, what should he be doing in terms of investments right now?
Consolidate all your investment and spread it. And most of his goals are, long term. So he should think in terms of, building a robust equity portfolio, a diversified portfolio, maybe an aggressive portfolio, and spread it over the next, maybe 12 to 18 months. Then be at it, keep investing. And I'm hopeful that, Indian markets will continue to do well relative to other markets for a fairly long time. If the India story, the way it is folding, or the kind of growth rate that we witness, and the global turmoil that we see, concentration in India might be beneficial. You are going to consume all your discretionary savings getting invested in Indian market will be consumed in India, so you don't have to necessarily repatriate it back, and you don't have plans to, as you have plans to be back in India.
Well, Dhirendra, when you take a look at the rest of his portfolio, after the things that you have asked him to do, would you say, how would you rate his portfolio? Is it a good job, or do you think it needs work?
No, for somebody who is 34-year-old and has money lent to, money primarily in emergency fund, yielding very low return, an NRI who has access to the Indian market, and this is all discretionary savings, it's quite disappointing that he has no equity exposure while he's till he's 34-year-old. Maybe his superannuation fund is managed like that, which I'm not very knowledgeable about. The Australian superannuation fund, where it will be invested, I hope that it's invested in in an optimal manner and with reasonable allocation to equity. So in that sense, it will be useful to actually start as early as possible, build his portfolio, and be at it. His 1.25 lakh rupee investment every month, which can be increased as his income rises over time, and that should translate into something meaningful.
All right, to wrap this up, here is your rating on your portfolio. Dhirendra says your portfolio needs work, and here's your list of things to do. You have to increase your allocation to equity in this market, especially given your age, and you're only 34. If you want to achieve those goals, then equity is an important part. Build an aggressive growth portfolio. We're going to send you a copy of our portfolio so you can use that as a guideline. Dhirendra, giving you very, very simple rules, which is use an SIP, stagger the money that you're investing, don't put it all in one go, and of course, keep investing and stay disciplined right through the course of the next 20 years. You'll find yourself in a very, very comfortable position. A quick segment we have on property starting this week. We're introducing a brand new segment called Buy a Home. The idea is to help you with information that you can use to invest your money when you're planning on buying a home. Sirjit has written in from Bangalore, Dhirendra. He's taken a home loan in the month of February this year. The property, he says, is under construction. He's been paying what's called pre-EMIs, which is basically interest that's being accumulated. Now, he's already paid interest for the month of February and March. As per his company's interest, he says there's no interest amount can be claimed, that he can't claim a tax benefit on this pre-EMI. That is true. The property is expected to be completed in June. He wants to know if he can claim pre-EMI while filing his tax returns. So, Dhirendra, unfortunately, as the rules go, pre-EMIs are not tax deductible, and that's that's an unfair rule in my opinion from the income tax point of view. What advice do you have for someone who's paying pre-EMIs? He's going to get his delivery of his home in the next couple of months.
What he is not able to avail right now, he will be able to avail in future. And so from that standpoint, it's not an opportunity loss forever. It is just the deferment of the opportunity or tax benefit, which he will be able to derive it earlier. And there is no surprise here. It'll amount to violating this law, and this law cannot be violated because it all gets documented. It's all specified in the tax statutes that how much when it is. The delivery is fairly well defined, the registration, and you become the title owner of the asset. So in that sense, I don't think there's a way of finding a way around it. You have to face it. That's the law. Then comes, basic things to ask is that is it an opportunity? Convert it into an opportunity. Work harder. If you can save at all, if you're finding it great difficulty, I don't think we can suggest you any way around it. But if you have some surplus, avail that. Go to the hilt, invest in the tax saving fund, and stop investing. If you are very tight on budget, then at a point when you start paying your, of course you have started paying your EMI, but at a point when you can discontinue it to avail the tax benefit, because tax saved is money earned.
All right, so we're going to take a quick break right now, but before we go into break, here are some quick takeaways for you. Remember, we learnt on this show that every time you pick a mutual fund and you start investing, you have to have a reason why that fund is in your portfolio. It should be part of a larger allocation. So if you have an international fund, you should know why that international fund is in your portfolio. The same thing goes for large cap, small cap, debt funds. Write it down and save it somewhere. So whenever the going is tough and you're wondering whether or not you should exit that fund, go back to the reasons why you invested in something, and that will help you make your decision. Quick break here on Investor's Guide. Coming back on the other side, we'll find out if you should continue investing in the Quantum long-term equity plan. That's on the other side. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET now. Thank you for staying with us. It's time for our product review, and we're looking at the Quantum Long-Term Equity Fund with Dhirendra Kumar because we've received a lot of questions about this fund right now. We want to be able to answer as many of them as possible. Avan will first take us through the performance numbers, and then we'll come back and talk about it.
Thanks, Faye. This week, we take a look at a fund that's not a new name for our investors, the Quantum Long-Term Equity Fund. With a 5-star rating on Value Research, the fund has had stellar returns over the long term. Let's quickly take a look at its performance over the last 5 years. The red line is the fund and the blue line is the benchmark. You'll see that the fund has been well above its category and benchmark up until 2012. In fact, the fund's performance was good even during the bear phase of the market. But you'll notice that its performance fell below its category in the year 2013 with a return of 9%. Although the fund slipped in its rating down to 3 stars during that year, the fund's performance got better in the following year with a return of 39%. The fund has had better returns than its benchmark and category ever since. You will also see that the fund's long-term returns have been promising with a 10-year return of 16%. The fund also performs better than most of its peers in a rising market. So is this a must-have in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. In the Quantum long-term equity, we just talked about it in the aggressive growth portfolio. We are holding it in that portfolio as well. And we're getting a lot of questions from worried investors who want to know whether or not they should continue investing in this fund. It remains 5 stars on Value Research. A return since launch of 15%, that's not bad at all. Is there a reason why investors should be worried at all?
This fund just turned 10-year-old. And in its 10 years, there has been 1 or 2 phases when it has been very disappointing. But most of the, even the disappointment, it has not diluted some of the basic things about the fund, which is, its core belief system, the way it conducts itself, its pricing, its cost, and even the way it is managed. Many a times, the strategy did not work. And I particularly disliked a phase in this fund's life when this fund was very high on cash, and it was to its disadvantage, but the fund believed so and stuck to it. So I like its belief, and it even when it goes wrong. And 2014, which was the worst year in the life of this fund, was primarily on that account. That apart, when I look at its exit load structure, the long-term investor in this fund benefits at the cost of short-term investors walking out of this fund, because the exit load charged to the fund gets back into the fund, and this fund discourages short-term investment, 4% for redemption within 6 months. So if you get into this fund, take your money out because the money went up, you will be charged 4%, and that 4% will benefit the remaining investors of the fund. For the period, it goes down by 0.5% for every 6 months, and only on a holding period of 2 years and more, it gets down to 0. So in that sense, this fund, by its design helping long-term investors, it is penalizing short-term investors, it is following a long-term approach, and these are quite likable things for a fund. That is what we believe in.
In fact, a lot of the, we've got a couple of questions from viewers saying that they have attempted to pull their money out, but they found out that there's a disadvantage, like you said, to short-term investments. Would you recommend someone who's invested in this fund right now stay invested, Dhirendra? And would you recommend this fund to new investors?
I would recommend this fund to new investors. 10 years is a long enough period. The return, despite the ups and downs, actually is good enough to show. And the cost will remain a enduring advantage. The exit load design will remain advantageous to long-term investors. So only investors who need their money, the investors who need their money in 2 years' time, 3 years' time, should plan their exit. And that should be guided by an investor's goal. But for all long-term investors thinking of investing in an equity fund, this fund qualifies as a very nice choice.
Right, this fund qualifies as an excellent choice. That's on your screen right now. Dhirendra, your star rating for Quantum long-term equity?
5-star after a while, because based on its performance, it slipped in the last 1 or 2 years. It has regained that and re-earned that.
All right, 5 stars there for the Quantum Long-Term Equity Fund on Investors Guide. Remember, it's really tough to get 5 stars on this show. That really means something. Very quickly, I want to take you through our hold or sell segment. Rakesh Hegde has written in, Dhirendra, you would like to invest 10,000 rupees a month for the next 10 years to get a corpus of 25 to 30 lakh rupees for the down payment of his home. He's already started using the ICICI Prudential Technology Direct Fund and the SBI Pharma Direct Fund, Dhirendra. I'm not very happy with the fact that his 2 funds in his portfolio right now are both specific to a particular sector. They're thematic funds. That's something we don't recommend. Do you recommend he continues those investments?
He's doing the right thing, but in a very wrong way. Sector fund is just not the right way of accumulating your savings. And these 2 sector funds, and the way he's approaching it, choosing the funds or the sector funds based on their recent performance, that he might be in for great disappointment. So have your principles right, choose a diversified vehicle, invest regularly, and you'll achieve your goals.
Let's also take a look at the other funds in his portfolio, for which he shortlisted another 7,000 rupees every month. The Quantum Long-Term Equity we just talked about, you gave it 5 stars. You said, you recommend it to investors. So I'm going to take that as a recommendation on this portfolio as well. iPro Long-Term Plan, Dhirendra, would you recommend he continues with, goes ahead with that investment?
ICICI Prudential Long-Term Equity Plan is an excellent tax-saving fund, and he should carry on.
He also wants to invest in the SBI Blue Chip Fund and the Mirae Asset Emerging Blue Chip Fund, Dhirendra. Would you recommend both of those funds as well?
Yes, by all means. These are exactly the kind of fund I was referring to, and these 2 funds can well be substituted for the 2 sector funds that he's investing in.
Would you like him instead, since his goal is very clear, he wants to buy a house in the next 10 years, would you like him instead to use one of our portfolios?
Yeah, one of our portfolio, but given the 10-year time period, and if he's investing in these 3 funds, these 3 funds will be reasonably will be very close to our growth portfolio without the fixed income allocation.
Right, our growth portfolio without the fixed income allocation is on your screen right now. You're doing fine the way you are. Just avoid the thematic funds, of course, and diversify your portfolios. Key takeaways: if you're investing in thematic funds, be prepared for as much of sharp disappointment as you will have a sharp, pleasant surprise. So these funds will do really well on some days and do really badly on some others. You should be able to take that stress. And of course, it might make sense for all of us to consider including an international fund in our portfolios. That's a wrap on Investors Guide. Dhirendra, thank you so much for joining us and answering all of those questions. Remember, if you have a question for us about anything to do with your money, get in touch. Our email ID is at the bottom of your screen. Both Dhirendra and I can be reached on Twitter as well. Our Twitter handles are on your screen. Thank you so much for watching.